the Teaching Tax Flow podcast, where the goal is to empower and educate you to legally and ethically minimize taxes paid over your lifetime.
Hey there, taxpayers. Welcome back to the podcast, episode 90 today. That's right, we're only 10 away from episode 100. We got a little special surprise for you come 102. Not even going to talk about that, though. But today we're going to dive into the history of U.S. taxes. So, very fitting, given the holiday. But before we do that, let's take a brief moment, as always, and thank our episode sponsor.
Are you leaving money on the table? Are you an accredited investor seeking new and exciting investment opportunities? Look no further than Integrated Investment Group, your trusted partner in financial success. At IIG, the focus is on delivering exclusive investment options tailored to your unique needs and goals. Contact them today and let their expert team guide you toward your financial aspirations. Wondering if you qualify as an accredited investor? Visit teachingtaxflow.com/IIG to find out and take the first step towards a brighter financial future. Integrated Investment Group, your path to financial success begins here. Securities offered through Cabin Securities. Member FINRA SIPC.
Hey everyone, welcome back to the podcast. As mentioned here in the intro, obviously you heard what we're going to talk about today, and we are going to talk about history, just a hair, and the purpose of U.S. taxes. So we're not going to be talking about what the Aussies are paying, the Canadians necessarily, what they're doing over this, overseas, across the pond, although we might bring them up a little bit. Got a fun little fact regarding those guys and gals. But talking history, welcome back to the show, Chris Pacuro, the guy I've known for 2.5 decades-ish. But how's it going, man? You ready for this one?
Well, yeah, isn't a score 20 years?
Oh.
20. Yeah, I thought a score was 20 years. Maybe we could check that. But
that's a good question. Yeah, let's verify this, actually. This is, as funny as it is, because we're going to talk about history, right? And I can't say that I am a history buff by any stretch of the imagination, but I am always interested in it because, it kind of makes me feel smart. It kind of makes me feel smarter in some conversations when you can drop these nuggets, right? Like totally unrelated, but if anybody wants to really amaze people at the dinner table, look up how to actually squeeze a ketchup bottle. Completely different than you think it may be.
Well, I know that the ketchup bottle back in the day when they were glass, you'd have to tap the 57 on the Heinz 57 and get the ketchup out. I used to work at a restaurant as a busboy and dishwasher, and once in a while the ketchup would not come out of the bottle.
Oh, I'm gonna bust that out one day. Next time we get together, I'm just gonna grab a knife, start pounding the bottom of that thing. Either that or people are gonna think we're just, we think we're at a wedding or something. I don't know. The little clink clink noise, but
well, when you think about hot dogs, it's 4th of July week here, Independence Day. I think about, there's always the debate of what goes on a hot dog. I mean, to me, it's ketchup and mustard. I could go, if I'm at a baseball game, it's mustard only. But a hot dog with ketchup only is kind of, Yeah,
it's kind of weird. It's half American.
Speaking of score, it is 20 years, John. So we've known each other for one score.
Hey, that's pretty
Congratulations.
Good. Yeah, 1.25 score. I'm going to update my LinkedIn, put that on there. But
I
know, and this is funny. So everybody that's listening to this, and you've listened to a number of our episodes, right? We tend to take it kind of serious, but we have a good time doing these podcasts, right? So this one, I had to kind of twist Curo's arm here a little to do, because as I always say, and I know it annoys the crap out of him sometimes, it's say, let's do it. Let's figure it out as we go. So it's very, very hard to say that to a numbers guy, by the way. If anybody knows their CPA, some of them are very, very, we won't say straight-laced, but they are very cut and dry. Chris is not. I mean, he's very modern, we'll say. You're not your normal guy, but some of these, he's like, nope, it's gonna be difficult, but I don't give a crap. I do the editing, so there you go.
Exactly. Well, so so we figured it's Independence Day. Let's talk a little bit about the history of taxes, and sometimes we forget one of the 3 laws of teaching tax flow. We have to understand that tax agencies are your involuntary business partner, which means that a portion of your income gets paid to your business partner. The Internal Revenue Service on the federal side could be a state. It could be a local city, county, and tax laws are written to encourage or discourage certain behavior. We know that certain industries, certain types of income are more tax advantaged. So we're going to kind of dive into that because the U.S. tax system is very complicated. Many people from foreign countries that look at our tax system just shake their head and say, what in God's green earth are you guys doing over there?
And these,
but
oh no, go ahead.
We're going to dive into it. We're going to talk a little bit about the history of tax here. And then we're going to bring it more modern, over the last score, for instance, and then look at the environment we are in right now. We're truly at a crossroads. We are under in the tail end of the last third of the Tax Cuts and Jobs Act of 2017. And we have a big election coming up in the United States, a presidential election, which, as we know, Congress and Senate trickle down from that. And this election is a huge pivot point in our tax structure. So we're going to talk about that. We're also going to do some special things in the fall where we're going to dive into each presidential candidate's tax plan. But that's the future. We're going to talk about history today.
Yes,
John.
we're looking forward, talking back, I guess, today, right? So, and kind of looking at, let's start. We won't go too far back because obviously, again, we're focused on U.S.-based tax history. I mean, we could go back to the darn Romans if we wanted to, and if their tax was probably, you pay with a hand or something crazy where, you're kicked off a cliff. But looking at the United States of America, right? And Chris, I believe I'm on this correctly. I do have to admit, though, again, not being a total history buff, I cannot give citations on all of these facts because they were found online, and some of them probably aren't the most credible considering some of the stuff that I looked up on Google and dates, things were spelled wrong. So anytime there's a spelling error, it completely shoots the credibility out the window for me. But if I remember right, too, this one I'm not looking up in front of me, but I believe federal taxes were actually created by or put in place or promoted by Abe Lincoln back in the day. And if I remember right, that was really to help fund the Civil War, if I'm not mistaken. So that was kind of the first, we're not talking Tea Party tax here. We're talking U.S. put in place and implemented tax. Is that correct?
Right. So the U.S. Constitution, when it was ratified in 1789, granted Congress the power to levy taxes. So remember that Congress is the law. They're the lawmakers, and part of that power is to write tax law. It's not the president. It's not the judicial branch. It is Congress. So Congress is given the power to levy taxes, and they levy all sorts of taxes: payroll, income, tariffs, excise, estate, et cetera, et cetera. So that power was given in 1789, but it really wasn't used until the Civil War. So to finance the war, there was something called the Revenue Act of 1861, and that introduced the first federal income tax. John, do you want to guess what that tax rate was?
Oh, geez. It was probably up there, I'd imagine, right? I mean, no, it was probably pretty low back then, all things considered.
It was 3% of any of your income over $800. So the standard deduction was $800, a flat rate of 3%, and that was to fund the war. So that's really where the federal income tax got started, and then it obviously grew from there. In 1913, part of the 16th Amendment was the Revenue Act of 1913, and this was a big pivot point. We went from a flat rate of 3% to a graduated income tax system with rates from 1% to 7%. And guess what? We are still in a graduated income tax system. What that means is that the higher your taxable income is, the higher rate of tax you pay on that income. Now listen to this one, Johnny T. When World War I was going on, the United States needed to raise significant amount of money. So if you're listening to this and you're upset about your tax rate, the top tax rate in 1918 was 77%.
Holy moly. So we're doing all right.
So that is huge. Oh, we are, and I've talked about this quite a bit. Right now, if you're listening to this under the Tax Cuts and Jobs Act of 2017, taxes are on sale. This is the time to potentially, if you have a taxable event that's looming over the next 5 to 10 years, to consider, as long as you have the cash to pay the tax, accelerating that event. Obviously, you should work with a tax planning professional and a tax strategist to make sure that makes sense for you, but taxes are on sale right now. So obviously, we are not in about 100 years ago, we were in a 77% tax rate environment. Tax reform occurred and taxes ultimately went down. There is a huge pivot point again under the Tax Reform Act of 1986. Yes, John, I had a hairdo at that point. I was in 5th grade. Under President Reagan, a lot of things changed. Our depreciation schedules changed. Our passive activity rules changed, which pertains to real estate. But the top individual tax rate in 1986 was 50%. And that top rate went from 50% to 28%.
Ooh, pretty significant.
So very significant. We're not, and I know that most of the listeners are probably too young for this. And quite frankly, I don't remember tons of this growing up, but I remember there was that term Reaganomics, which in trickle-down economy, which basically the theory was that Ronald Reagan felt was that, hey, reduce the taxes as much as possible. They got reduced by almost 50% because if people have more money, they will actually spend money and put it back into the economy, and they will use it in a wiser fashion than the government. So the consumption by the consumer will ultimately create a more fair economic environment, and in general, people will consume more if they have more in their pocket.
And I have tons of little fun facts. We could pick at certain states a little bit, but I think something that's super relatable to everybody too. And Chris, back to our kind of glowing highlight that we always make in teaching tax law about, tax laws are written to encourage and discourage certain behavior. We can't forget about Mr. Capone from Chicago, right? Mr. Chicago Pizza Man is, some people call him. But again, we'll make fun of certain cities. Being from Michigan, it's very easy to poke fun at other states that surround us. But Capone, again, I didn't know the guy, but he knocked a handful of people off the census, shall we say, but did not go to jail for that. The IRS is actually who took him down. I think they sent him to prison for 11 or 12 or 15 years or something out in California for tax evasion, right? So that's probably the best, most popular example of the power of the IRS in some regard, right?
Absolutely. That's a famous fact, and it's correct. So we get into the 21st century, right? And again, there's just theoretical differences on how we should tax, how America should tax its taxpayers. That is a mouthful.
That's a tongue twister.
Correct. So as I got into this business in 2007, 2008, we were under what are called the Bush tax cuts, where there was a Tax Relief Reconciliation Act of 2003. Now that lowered tax rates, that reduced capital gains, increased child tax credits, and ultimately was again another lower tax environment. Then when President Obama was elected, he changed some things up as well. And some of the Bush era tax cuts were made permanent, But then there are also some changes to the what we call the ACA, Affordable Care Act, that mandated people have a certain type of health insurance and penalized people significantly based on your income. In companies also, if they had a certain amount of employees, for not being ACA compliant. Now, 2017 comes along. Donald Trump wins election. He signs the Tax Cuts and Jobs Act, TCJA. That's what we are in right now, and it really overhauled the tax code. What this act was intended to do was to simplify things. And some say it did simplify things, some say it didn't. But personally, I think it simplified personal taxes, and I think it complicated business tax. The corporate tax rate, so a lot of people don't understand that C corporations pay a tax on their net income. And that after they pay their tax, so let's say General Motors or Tesla, if it has net income, it has to pay a tax on that. And then from the remaining money, it can pay dividends to its owners, to its shareholders. Well, that corporate tax rate was 35% before Tax Cuts and Jobs Act. Tax Cuts and Jobs Act reduced that corporate tax rate down to 21% because they wanted it to more mirror a personal tax rate. It also increased the standard deduction, but yet it limited many deductions that people used to take. So, for instance, unreimbursed employee business expenses, moving expenses, those sort of things were taken off the table, and it limited your SALT tax deduction, state and local income tax deduction. So tax rates went down significantly, and that's the era we are now. We also have something called the Qualified Business Income Deduction, or QBI. That's also known as Section 199A. So individuals can now obtain up to a 20% of net income deduction. There are phase-outs, there are rules based on their business income. Finally, John, then we had COVID hit, right? The pandemic hit in 2020. Donald Trump was not the president anymore. Joe Biden who was our current president, was a president, and he signed the American Rescue Plan Act, created the Employer Retention Tax Credit, which created the economic impact payments to people and to try to keep our economy going. And now we're here now. So ultimately, like I said, the theme is, if you're listening, taxes are currently on sale. What is important is to make sure you understand what the laws are currently. So the Tax Cuts and Jobs Act sunsets in 2026. Depending on the election results, it could get extended, it could be made permanent, or it could go away when it's expected to go away. It would be tough to probably repeal it. So that's where you have to really look at your situation and determine how you're going to tax plan.
And we always talk about tax planning, right? It's something that a lot of people don't know what it is until they realize that they don't know it. And then, we're talking about taxes being on sale, right? I think, again, disclaimer, I don't know how true 100% of these are, but if you think your job is, easier now than it was back in the day, or anybody does, put your hands in we'll call it accountant, because who knows how long the CPA, call it accreditation, license, title has been given. But I'm seeing here, right, that looking all the way back to 1913. Okay, so we're going back 100 plus years. I won't even say Chris had hair back then. Chris wasn't around back then, obviously. But so I see here the U.S. tax code, right, was 400 pages long in 1913. That's 400 pages. That's longer than most books I've ever read. Maybe some textbooks in college. Let's be honest, I didn't read those either.
No, you didn't.
Come on. No, I never read those things. It's too bad AI is not around, or wasn't around when I was there. Although, let's say that, unrelated to, I kind of am a little bit jealous when some students were around maybe a year and a half ago, when AI started to get into it, before all the professors and everybody knew what it was. You just look like a genius. But back to 1913, 400 pages in the U.S. federal tax code. Basically, the pub is, I think we refer to it as now. I'll pause for a second and everybody guess how many pages are in today's, right? Even looking back at 2010, I think is what it references. 400 in 1913, 70,000 now.
Yeah, I mean,
that's crazy.
And it's not easy reading. It's just not easy reading. So let's think about this when we're talking about how to plan for taxes. And as I've said a million times on this episode already, taxes are on sale. So I want to just talk through as we wrap it up, what our tax rates are looking like today versus where they were at 6 years ago, pre-TCJA. A couple of things I want to mention. Understand that different types of income are taxed at different rates. Some income is taxed on your net income, rental income, business. Some is taxed on your gross income, interest income, dividends, W-2 wages. So you definitely want to be taxed at net income. But when we talked about federal tax rates, let's talk about the corporate tax rates first. I mentioned that the maximum corporate tax rate was 35% before Tax Cuts and Jobs Act. That corporate tax rate starts at 15%, but it is as high as 35%. Now it's a flat 21%. Someone that was a married couple with a adjusted or taxable income of $190,000 would have been in the 28% marginal tax bracket. Now they're in the 22% marginal tax bracket. A married couple with $80,000 of taxable income would have been in this 25% tax bracket. And now they're in the 12%. So my point is, really dive in. If you're listening to this, you have a personal invitation to jump into Teaching Tax Flow, our educational library, which is complimentary, and learn about how to calculate your marginal tax rate and figure out what strategies you should implement to legally and ethically reduce the tax you pay in your lifetime. And once you start getting that knowledge, then we can start talking about, bonus depreciation and research and development credits and the tax advantage of owning real estate and the Section 121 exclusion and the Augusta rule. All those are really cool tools that you can put in your tool belt, but you first have to understand that this is, that these laws are written to encourage and discourage certain behavior. Some of that behavior is financial, and quite frankly, some of it is social.
And then, Chris, too, as we wrap up here, right? I'll kind of end us with some more funny facts. We won't call them fun. We'll call them funny. And they're not federal. These are more state, right? So if somebody's listened to this, I am not responsible for the milk or water or pop or any beverage coming out of your nose, because some of these are kind of ridiculous. Not to mention, one thing that I see here is that Canadian cereal companies receive a tax break for putting a toy inside the box. Kind of weird, but okay.
Ooh.
Interesting. So there's the Canadian knowledge. So here's a couple of things. So here is one federal one. Okay, in 1987, the IRS began requiring taxpayers to list their dependent's Social Security number on returns. Again, I don't know if that's 100% correct, but that being the case, it is mentioned that 7 million children vanished from tax returns when they required that. So who would have thunk, right?
So it's at least once a year someone asks, maybe with tongue-in-cheek, can I deduct my pet? Ultimately, people were putting their pets on their tax return as a dependent until they started requiring a Social Security number, and that's exactly what happened.
7 million.
They were in the house. It didn't say children, it said dependents.
Very true. And speaking of things being worded incorrectly, right? So again, now these are a couple state ones. I think I got 4 of them here. I'll breeze through really quick. So Madison Square Garden, right? The entertainment facility, we'll call it, in New York. Okay. It looks like they were exempt from property taxes since 1942, only because, the term of the agreement looks like it was for 10 years long, because it was worded incorrectly. So as long as the Rangers and the Knicks are playing there, they're actually property tax exempt for existence because of miswording of something. So again, kind of different from, we're not talking U.S. based, but these are U.S. cities and states. Same thing as, Washington, right? State of Washington, bottled water is taxable. However, if you can convince a doctor to give you a prescription, you can request a sales tax refund. So kind of interesting. New Mexico, you no longer have to pay state income tax, it looks like, once you turn 100 years old. So you can be old and cheap at the same time. You'll be good. And then Texas, this one was kind of funny. It's kind of a stinky one. Texas looks like they charge a sales tax on deodorant, but not on antiperspirant, because the FDA requires a drug facts label to be on there. So I don't know if that's, specific to Texas or not, but it sounds legit. And then it looks like here Pennsylvania charges an 18% flood tax for every bottle of alcohol sold. The law was originally designed to help rebuild Johnstown after the flood of 1936, but still remains in effect today. So as long as people are paying the tax, why poke the bear? But just reading some of these I thought were kind of funny. So I know, Chris, thank you for diving into the history here. We can kind of say, class is no longer in session. Everybody's free to go. Your attendance has been recorded and documented, and we appreciate it. But as always, we'll see everybody back here next week on the Teaching Tax Flow podcast.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.